Hello, everyone. This is Andoni Almeida with BERYL Consulting Group, your host today. I am pleased to be joined by Roy Niederhoffer. Roy is the founder and president of R.G. Niederhoffer Capital Management, a firm that has pioneered quantitative trading for over 30 years. A Harvard-educated expert in computational neuroscience, Roy uses his deep understanding of human psychology and behavioral bias to navigate global markets. He is renowned for his contrarian investment style and his firm's ability to thrive during periods of extreme market volatility, such as the 2008 financial crisis. And beyond the markets, he is a dedicated philanthropist and musician, notably serving as the chairman of the board for the New York City Opera. Roy, welcome. It's great to have you here.
Thanks. Great to be here.
Let's jump right in. If most diversified portfolios ultimately collapse into the same underlying risk exposures during crises, what does true diversification actually look like in practice?
I think there are several factors that come into play during crises that tend to be present in pretty much every multi-strategy portfolio, every diversified portfolio. And actually, some of those factors have changed a little bit, more than a little bit over time. Obviously, equity direction is one of them. I think everyone knows that. But liquidity is one of them, that it's hard to find cash at those times. I think volatility is one of them. Market volatility tends to increase across every asset class. Obviously, there's been a pattern where VIX increases and you have dislocation, normal relationships don't hold. So any sort of convergence trades tend to expand and go out of whack. And then you have things that should be uncorrelated tending to correlate to one course. And typically you have a flight to quality, but that's the one that's really changed. Quality is something that used to be fixed income, sovereigns. But the real change in portfolio management has been that the 60-40 bedrock of portfolio construction is no longer applicable because of the threat of inflation from the 40 trillion of debt that we've accumulated in the US. If we do address any sort of dislocation with lower interest rates, well, the threat of inflation from those lower interest rates, from that liquidity, then creates a massive funding cost for the government. So we can't do what we've done every day, every time there's been a crisis since October 19th, 87, a day I remember very well, the way the bond market started to rally at 5:30 p.m. that day. I think today you have to think of bonds and stocks as correlated assets. So that's been the big change in portfolio construction. And so now everything is correlated. And even the crypto markets, which started off as a diversification from that, has become a risk asset as well, at least to a point. We have yet to see what happens in a debasing world. Issues during a liquidity crisis, market dislocation for portfolios. Correlation, liquidity, and the lack of safe havens. So we try to address that in our strategy.
Excellent. And it is very interesting how those correlations have changed over time, and you have to adapt to those evolving conditions. And why do so many supposedly uncorrelated strategies converge under stress? And what signals should investors watch for before that correlation spike happens?
I think one of the most powerful reasons for that is that all of us are wired by evolution into optimism bias and status quo bias. And these liquidity crises tend to be fairly rare, and we tend to inoculate ourselves in our memory that it fades and it doesn't seem like it was as bad as it actually was when it was happening, because really we've been bailed out each time by the Federal Reserve. And so the memory seems like it wasn't quite as bad. I mean, look, if Alan Greenspan hadn't made the phone calls that he did on October 19th, if we hadn't had QE and in the fall of 2008 and a bunch of other versions of it later on, late 2019 and early 2020, the multi-strats hadn't been bailed out by the Fed. And a few other times that I can remember, the whole market would have collapsed. Oh, LTCM being another one I remember very well. But those memories tend to fade. As a result, people tend to position themselves as though these things won't happen. And then when they do, it tends to be a big surprise. And everyone has the opposite trade on, the optimism trade. And each time it always seems to happen in some way that, oh, it could never happen. And in addition, especially over the last few years, every single market decline has been very, very rapidly reversed. I mean, if you think back, it's been since 2007 that there's been a sustained market decline. Every other decline since then has been rapidly, sorry, I guess we can say 22. It wasn't really that big a decline, but it's been pretty much the highest Sharpe ratio I can remember in my career of the stock market going up. And I guess maybe 23% was the biggest decline, peak to trough, and it came roaring right back. So it's been very, very easy to buy the dip. And so the tendency has been to forget what could happen. My view is that one of the greatest dangers that one faces in a portfolio is to think that the left tail is always going to be somewhat limited in time and in magnitude. However, having spent my entire career mitigating people's left tails with my strategy, mitigating volatility, I've actually become very, very afraid of the other tail as well. And it's a story I love to tell. I'm going to tell it one more time because it's so powerful. And it happened in a bar in Geneva. And I was speaking with a gentleman who was a pharmaceutical distributor in Venezuela. And he said, Roy, after speaking with 𝐤𝐭 𝐤𝐿, I was so optimistic about what would happen. He told me, you're the kind of man that I want in the new Venezuela. And then 2 years later, and this is the line he told me, I was a rich man in Caracas and a poor man everywhere else in the world. And I knew it was time to leave. And that one sentence changed my life because I recognized that in a country that was so wealthy, Venezuela was the richest country in South America at that point, and Chavez destroyed it. And this guy left, became an expat, selling to all of South America. And I realized that we were probably going to head that way in the United States, potentially. And so the right tail, a world in which financial assets begin to appreciate dramatically, not because there's a AI boom writ even larger, some other technology that takes stocks up even further and companies make even more money. But the denominator, the thing that stocks are denominated in, starts to decline. And every asset starts to appreciate. And as a result, everybody makes money on paper, but not in real terms. And that right tail is the one thing that is an existential threat to families, to endowments, to sovereigns. If your home currency devalues, that's what destroys you. Because unlike the left tail, the market crash, where 10 years later you have the S&P 500 CEOs working for you to cut costs and invest and make money, you lose 10% a year in real value even for 15 years. You can't come back from that. So that right tail is just as much of a risk. So I believe it's a two-tailed world now, not just a left-tailed world. And it's incumbent on every tail risk manager to think about both tails, not just the left tail. And that's a very tough situation. You have to keep up with the S&P on the upside or more and be cognizant of the downside. And that's what we try to do.
Certainly scary to think about that right tail risk, but I agree with you that it is something that all allocators and asset managers should take into account.
I'm guessing you have a European background.
I'm from Mexico City, but I have some lineage from Spain. So you are right in that sense.
So there's certainly both in Mexico and in Spain some history of debasement that people are well aware of. So
100%. Shifting to negative beta. Negative beta is often described as rare and expensive to maintain. What separates a genuinely protective strategy from one that only appears defensive in normal markets?
It's an interesting question. Obviously, you can get inverse beta just by being short all the time. That generally doesn't help portfolios. Selling S&P futures, for instance, that just that you have as much negative return as the inverse expectation of the S&P, and stocks go up over time, particularly in this debasing environment where one of the greatest risks is that we just print money to address this 40 trillion in debt. The dollar, which already has gone down, I mean, it used to be, I like to give this example. In 1900, for 7 cents, you can have all the oysters you can eat and all the beer you can drink. And now that might cost you, what, $200? So that's a lot of debasement in real oyster terms. And so maybe it's going to be 1 to 1/3000th in the next 125 years, or maybe it's going to be 1/30,000th in the next 125 years. But whatever that debasement is, it could be, that's a pretty big appreciation of the stock market. I think negative beta could be a very costly situation in that world. So you have to have positive return in that situation as well. And that is what we try to do. And it's hard. The problem with that type of investment is that it looks very, very different from everything else in a portfolio. An inversely correlated investment is going to be about as far from the stock market as you can possibly get, because in the best years from the stock market, if you're going to really maintain that inverse beta to the stock market, you might have a tracking error of 50 or 75 or 100% away from the stock market on both sides. I mean, I have literally been a plus 60 when the stock market's down 30. That's a 90% tracking error. But I've also been, down 10 or down 20 when the stock market's up 20. That's a huge tracking error. When you put those two things together, it smooths out the stock market's return incredibly beautifully. And the thing is like almost a straight line. But what I do, instead of trying to show people how this improves their portfolio and forcing them to look at that ingredient, that insurance policy that pays you to own the insurance, I actually put the stock market on top of that together. And we do the rebalancing and we force people to rebalance and do it for them. And that interesting product has been a big seller for us most recently. And I've discovered rather than trying to teach people about inverse beta with positive returns, it's easier to actually sell them the whole thing put together. One question I like to ask people is, what's the Sharpe ratio of your fire insurance, let's say? Because that is, if you think about it, a negative beta product, right?
Right.
That always loses money. It's the worst investment you'll ever make. It has an infinite negative Sharpe ratio. You just pay $10,000 a year of a big building or something like that, year in, year out, until you need it. And then, boy, does that thing pay out. So that's like the ultimate negative beta product, right? So, and you could go a lifetime and literally have zero payoff on it. But our product has that kind of payout sometimes, but with a positive rate of return. So we pay you to own that fire insurance, essentially. Now, of course, sometimes it doesn't make money. And the idea is if you then put it with a positively appreciating product like the stock market, which sometimes has down years, then the combination is very interesting.
I think that's a great way for people to understand why it's important to have this insurance, as you say. And you've been able to thrive during periods of extreme volatility. So how can volatility become a portfolio advantage rather than a source of risk, especially during periods of systemic market failure?
Well, I think you need to start with a reason, a link between a strategy and something that is true when stocks go down, causally linked to something that occurs reliably when stocks go down, other than the stock market just going down. As I said before, you don't want it just to be short S&Ps. You have to have some alpha beyond just direction. So in our case, there are two things. First, the volatility itself increases across all markets, not just equity market volatility, but in all financial commodity markets, currencies, everything increases in volatility when stocks go down. And that's been ubiquitous across all markets and a constant throughout our career. And by the way, though, it's not necessarily true in debasing times. If you think about the Venezuelan or Zimbabwe stock markets, the more inflation there is, the more volatility is on the upside. And we saw it in Bitcoin. When Bitcoin was sort of thought of as a debasement, maybe it will still be a debasement hedge. the vol is on the upside, not the downside. And there have been a few times, in fact, recently where the skew has been on the call side, not the put side in equities. So it's something to watch for. But at least for the most part, stock market vol has been more on the downside. Although again, recently in April and in May, the stock market vol was higher on the way back up from the low in March, when it hit the low in the war. It went up quite a bit faster than it went down from January to March. Little hint perhaps of what is happening, maybe. In any case, though, since I've been alive, stocks have gone down faster than they go up. So that's one thing. Second thing that happens, when markets are volatile, when stocks are going down, because of people's loss aversion, because of people's tendency, as Daniel Kahneman, the great economist and Nobel Prize winner, pointed out so vividly, we hate to lose more than we love to win. So people get very afraid during times of emotional arousal like that. We revert to instinctive behaviors that are built in by evolution, and our behavior becomes very predictable. So our models are designed to capture this predictability. That's what we look for as the fundamental thesis in our trading strategies. That's where we begin the search for ideas. And we find these patterns in historical intraday and interday price patterns that are ubiquitous across markets. So our strategy tends to work better during volatile periods because people are more predictable during these volatile periods. And that has also been the case for decades. So that's another thing that we have going for us. Our strategy is more accurate, and we also have larger opportunities during these periods, because for short-term traders like us, there's always a cost of entry and exit. And when the market is moving more, the entry and exit cost does get somewhat larger, but relative to the amount of money that you're making, if you're correct, you're on a percentage basis more accurate, and your entry and exit cost is smaller relative to your mean that you're capturing.
That makes a lot of sense. And in an environment where liquidity shocks can erase diversification benefits overnight, how should investors rethink traditional portfolio construction models?
You have to predict your need for diversification. Many people, and I've seen them try, have said, well, the stocks are on the high. I don't really need any downside protection right now. I don't really need diversification. Again, optimism bias, recency bias, status quo bias. Another one is the ostrich effect. People don't even want to think about anything that could go wrong in their portfolio. It's a little bit like, I don't want to go to the doctor and get an MRI scan because it might find something, even though, or et cetera. I don't want to take that medicine just in case.
Right.
So we hear that a lot. Or even worse, they only want to buy the protection at the bottom of the global financial crisis after the stock market is already down 50%. That again is maybe not the time to buy the protection. The reason you have the protection, or the reason you have, in our case, diversifying strategy, is so it has the great opportunity to make money for you, so that you have cash in your portfolio, so that you can buy, like I hate going back to fires, but it was such an obvious metaphor. We had these horrible fires in Pacific Palisades. Imagine if you could go in and say, wow, can I provide liquidity, and can I, buy distressed assets, or even the global financial crisis itself. Imagine if you could come in and, buy these things for 7 cents on the dollar, 10 cents on the dollar, where people were doing anything to get out of these positions. People made a fortune buying converts and, distressed debt and all these things that were selling on the cheap at those times, if you had something liquid and something that was giving you cash. And that's what happened to me. We were daily liquid, and we were up 60%, 70% on the year at that point. And people were taking money out of my fund right and left. We were how many hedge fund managers have 60 or 70% and have 50% redemptions? That's what happened to me, because we were liquid. And
Right.
boy, did our clients make money from those trades that they put on with the cash that they took out of our funds. And that's not the first time, the only time that that's happened to me.
People tend to think about that insurance when you're at the market bottom, but it's so important to think about it when things are going well, so you can be protected before something.
Exactly. And actually, one of the things that having something in your portfolio already is that it prevents you from making silly mistakes on the lows. Imagine if even just in 2020, how many great stocks there were to buy in March, what was it, March 16th or 12th or whatever the low was in 2020. There are things on sale then that those are all-time lows since then. And or worse, if you got margin called or even just had to sell for liquidity reasons because your portfolio had hit a low and you panicked or just for whatever reason needed to sell. If you had a portfolio that was stable because you had true diversification at that point. And remember, the bond market isn't serving that purpose. So your whole portfolio is going the same direction now. And now with all the debt that we have, it's really tough to find diversifying assets. A lot of people use trend followers for this. And I love trend following. I mean, part of our strategy is trend following. We have maybe 10 or 20% of our strategy is trend following. Trend is a diversifying strategy. Sometimes there's trend when stocks go down. Sometimes there's not. Trend has made a total of about 25% since 2003. The return of the SG-CTA index, 25 total percent in the 25 largest peak to trough drawdowns for the stock market. 25%, during which time the stock market's down about 450%. So I wouldn't call that protection. I would call that diversification. And we've made about 10 times that. Wow. So that's protection. So a protective strategy should be up a lot during those periods. A diversifying strategy shouldn't lose money. And what's happening now is that the bond market is now, instead of a protective strategy, it's a diversifying strategy. Trend following can be protective. It was in 2022. Sometimes it's been since 2008. Sometimes it has not been. So that's another interesting place to look.
Agreed. Thank you very much for your time, Roy. This was a great conversation, and
these were some very deep and thoughtful questions. Thanks for those as well. I did not expect. I thought it would be like, what's your favorite book?
We'll save that for another time.
Wait, can I just answer that question? Thinking Fast and Slow by Daniel Kahneman. Unsurprisingly.
Thank you for that. So once again, thank you very much for your time.
Thank you.
A great conversation. I'm your host, Andoni Almeida, and we'll see you next time at BERYL Elites.